Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Thursday, 31st July. Coming up on the show, as the August 1st trade deadline rapidly approaches, it's deal for South Korea, but no deal for India. After Microsoft and Meta reported earnings after last night's closing bell that beat expectations, can Amazon and Apple do the same today? And we'll have the fallout from the Fed decision to keep rates on hold. So grab your coffee and let's own the morning. So our first thing to know before the opening bell rings takes us to trade deals. Tomorrow is the deadline that Washington imposed for deals to be done. India and the US failed to come to an agreement, but South Korea did manage to secure a deal. Let's see how that's impacting Asian markets. South Korea agreed a 15% levy, avoiding a higher rate of 25%. But shares in the big car makers there, Hyundai and affiliate Kia, fell sharply, dragging down the Kospi there, as you can see. Under the trade deal, Hyundai and Kia could take a $5 billion hit. South Korea has also agreed to invest $350 billion in US projects in shipbuilding, chips and batteries, as well as purchase $100 billion in US energy products. But India has failed to agree a deal with the US. As a result, it will be hit by a 25% levy on its imports. Last year, India sent $87 billion of goods to the US. Indian Prime Minister Narendra Modi's refusal to open up India's agriculture sector seems to have been the big stumbling block here. Now, the next thing you need to know before the opening bell rings keeps us on the tariff theme, but this time we're talking about copper. President Trump slapped a 50% tariff on copper imports yesterday, and just look at what it did to the metal's price. Prices are down over 20%. In fact, if this sell-off holds through today's session, it will mark the metal's largest single-day decline since 1989. Copper miners like Freeport-McMoRan and Southern Copper also saw their share prices fall significantly. Now, copper is the third most consumed metal behind iron and aluminium, and the US imports nearly half of its copper, half of which comes from Chile. It's also used on all sorts of products, from construction materials to electronics. And the last thing you need to know is that the Mag 7 continue reporting today. Amazon and Apple are both on deck after today's closing bell. Apple reports Q3 earnings. Its stock is pretty flat before the opening bell, as you can see there. It's facing two major problems. First is the long-awaited ruling on remedies related to the Justice Department's antitrust lawsuit against Google, expected sometime next month, which could cost Apple's services business an estimated $20 billion a year. The second is Apple's AI struggles. There's still no clear sign when its upgraded version of Siri will hit the market, and with competitors also hiring away Apple's AI talent, certainly isn't helping sentiment either. Meanwhile, Amazon shares, well, look at how they're doing in the pre-market. They're up over 3% as it prepares to announce Q2 earnings later. Analysts are expecting revenue to grow by 9.5% year on year to hit $162.2 billion. Analysts will be focusing on the artificial intelligence-powered growth of Amazon Web Services Cloud. There will still be questions, though, on how tariffs are impacting the company's retail operations. Now, many investors will see these earnings as crucial. My colleague, Josh Schafer, explains the impact they have on the whole market.
I want to focus in on one of our big tech charts from our chart book, which of course spanned a lot of topics, including markets and the economy, but big tech was obviously a key part of what folks were talking about. This chart comes from Venu Krishna over at Barclays. And what Venu is pointing out here, we're looking at in yellow, it is near-term earnings growth. Green would be multiple expansion, so that would be stocks rising, not necessarily with their earnings growth. And purple is your price return, sort of the spread in between those two things. The key one to focus on here as we're talking about big tech is, of course, the only square that we have on here where next 12-month earnings growth has actually risen more than the price year to date. And so what that tells someone like Krishna is, yes, earnings growth has been strong for big tech. Also, perhaps it means that big tech would have more room to run if they continue to beat consensus. One thing Krishna has followed for several quarters now, of course, is analysts often do not have earnings estimates that come in below or that are lower than what companies report. That has specifically been true for big tech. These companies have been consistent beaters, meaning that this yellow line would probably continue to rise on our chart here over the next 12 months. And if earnings continue to accelerate in big tech, as we saw this last quarter, where people thought the growth rate was slowing, it wasn't actually slowing as much as people thought. That spawned a rally in some of these big tech stocks. Krishna argues that that will likely happen again this quarter.
We're going to focus on the two Mag 7 stocks that reported after last night's closing bell now, Microsoft and Meta. Microsoft is set to become the second company in the world to reach a $4 trillion market capitalization after reporting quarterly earnings that beat Wall Street expectations, sending the stock soaring in pre-market today, as you can see, up over 8%. Remember, Nvidia became the first company to reach that milestone earlier this month. The company's last results confirmed that it's a leader in the artificial intelligence boom that's lifted mega-cap tech stocks and the broader market for the last few years. Microsoft reported better than expected growth in its cloud business, and its closely watched Azure cloud computing unit posted a 39% rise in sales. Microsoft expects fiscal first quarter capital expenditures at more than $30 billion and full-year revenue growth in the double digits. The stock is the second best performer among the so-called Magnificent Seven megatech stocks this year, since its low on April the 8th when President Trump's sweeping tariff threats spurred a broader market sell-off. The stock surged nearly 45% to close just shy of a record high ahead of its Wednesday earnings report. Now, moving on to Meta, and just look at what it's doing in the pre-market. It's up there around 12%, as you can see. Its Q2 results outperformed expectations, and the company offered a better than expected outlook for Q3. The earnings announcement comes amid Meta's AI spending and hiring spree. Meta is also spending on AI data centers, with CEO Mark Zuckerberg saying last week that the company is investing hundreds of billions of dollars to build several multi-gigawatt data centers around the country. Gil Luria, managing director at D.A. Davidson, gave his reaction to Meta's earnings to my colleague Josh Lipton.
They were able to grow revenue 22%. That's a significant acceleration from last quarter. And the context is Google grew its ad business closer to 12%. So Meta is gaining significant share in the digital advertising market. They're doing it with while keeping, at least to date, expenses under control. And therefore, investors have patience for the CapEx guidance that they're providing. For this year, it's only a slight increase, but there was a comment in there about a significant increase in CapEx again into 2026. Investors will have patience for that. As long as revenue is growing this fast, they're selling a lot more ads and they're selling them for a lot more.
So they're spending, Gil, but is your point, listen, we're seeing the ROI on that spend?
To some extent, it's more that investors with Meta have always had patience for the longer term investments when the current business is doing well. When the digital advertising business that is the lifeblood of Meta is doing well, investors have patience for Reality Labs, for Metasphere, and now for these longer term super intelligence investments. That's what's happening, which is to say, the AI investments do pay off in the core business. This is how we sell more ads, and we sell them for more, is by being very good at AI, by being very good at developing the right feed and serving the right ads, and then being able to monetize that, which Meta is getting increasingly good at. But the investment is well beyond that.
We're heading for a short break now, but when we return, we'll be looking at tariffs and how they're impacting on one Chinese EV maker. Stick with us here on Market Sunrise. Welcome back. Well, just over the past 2 days, we've seen multiple warnings about how tariffs are affecting the bottom line for car makers around the world, from Mercedes, BMW, Aston Martin, Stellantis, Kia. And the latest on that list is Ford, which also reported earnings after the closing bell last night. The car giant reported a Q2 earnings up better than expected, but said it had taken an $800 million hit due to the fact that tariffs will cost it $800 million so far, and that for the whole of 2025, that tariff hit could amount to $2 billion. So why are tariffs so problematic for the auto industry? That's a question I put to the Europe CEO of Zeekr, the luxury Chinese EV maker. Take a listen to this. What's your take on the current trade environment in terms of tariffs and how that's impacting on your production and across, trying to get, goods to consumers?
Yeah, first of all, I have to say we are a very clear supporter of fair trade, and we are opposing, of course, the tariffs, because I believe that tariffs only hurt consumers at the end. And that's why we are, and this is what was our homework the last month also after tariffs have been announced, we had to revise and to look into our business cases for Europe. But with the speed of China and the agility of all our colleagues in China and supply chain and manufacturing network, we found a way now, even with the tariffs, to have a competitive offering in all the markets. That's why we are continuing our growth now. We're continuing the growth in terms of products and in terms of markets. And that's the plan for us to enter and expand in Europe.
Are you not worried, though, that China is definitely top of the president's hit list in terms of tariffs? Aren't you worried that that could impact on Zeekr?
The impact on the consumer is there if prices will be adapted. So that's why our main goal was, when we have been discussing how we react on the tariffs, that we need to find a way to find the sweet spot and price point where our cars are attractive for the consumer, and that's the reality, what we have been promising also to customers. We are there, and that is independently from the tariffs.
Now, at the moment, your shares are listed on the New York Stock Exchange, but we know that Geely is looking to take over completely and take the firm private. Can you tell us a bit more about that?
Actually, I'm responsible for Zeekr in Europe, so I cannot comment too much on the Geely corporate topics. However, the consolidation of Geely will bring us a lot of synergies and benefits. What is important for us at Zeekr in Europe is that we will continue the growth with a distinctive, clear brand positioning, also with a very clear go-to-market approach where we find our place in the premium and luxury segment. The spearhead of technology, that's where we will make the difference. And that is what we leverage much more in a more consolidated Geely corporation with a big support of that giant.
So you see that as a positive rather than a negative?
Absolutely. That is the way forward, which brings us much more opportunities to be more leaner and be more prepared for the future.
Now, I want to bring you to a different story. Recently, Reuters reported that Geely had tried to boost its sales numbers by buying insurance before the cars were actually sold. What's happened there?
I've seen that coverage. Of course, again, I cannot comment on the things which happened there in China. I just know the colleagues in China did already a clear communication behind it, that they are not into 0-kilometer used car sales. And I just can say for Europe, and that's what is more important for us, we are not looking for short-term sales. We're not looking for just to fix the next month. For us, it's important to gain the trust of the consumers, to build a brand, and to have a midterm strategy which is sustainable. And that is what we have been striving now the last months to prepare.
Interesting stuff there from a Chinese EV maker hoping to compete with some big names in Europe. OK, time for a quick break, but we'll have trending tickers and more on that Fed rate decision. So stay tuned to Yahoo Finance. Welcome back. Time for some trending tickers now. Well, we start our trending tickers with today's big moves in the global AI race, an area where investor enthusiasm keeps growing. And here's one name you need to write down: Aker ASA. The Norwegian industrial conglomerate saw its shares pop by more than 8%. And as you can see, they're now up by, I think, more than 10%. That's right. That's after Acre announced a partnership that involves the biggest names in artificial intelligence. Acre will partner with OpenAI and N-Scale Global Holdings to build a major AI facility in northern Norway, marking OpenAI's first Stargate center in Europe. Dubbed Stargate Europe, the project aims to install 100,000 NVIDIA processors by the end of 2026, creating one of the continent's largest AI infrastructure investments. According to a joint statement from the companies, the project will be powered entirely by renewable energy. The investment for the site starts at $1 billion in phase one, but the company said that the capacity could grow tenfold in the following stages. And that's all great news for NVIDIA, as it adds to optimism for demand for its AI chips. The world's most valuable company is continuing to rally in pre-market this morning after closing up more than 2%. It's now over $180 mark. And Morgan Stanley has actually raised its target to $200 from $170, all while maintaining an overweight rating on the stock. Let's move on now to our second ticker, Carvana. The online car retailer reported a six-fold increase in net income and record quarterly sales of used vehicles, countering the skepticism that had been spread by some short sellers recently. And investors certainly reacted to the news. Shares jumped as much as 17%, now just above 16% in our after hours trading. As you can see, up 16% in pre-market. Now look at another chart. Carvana is up more than 160% over the past year. And that's being called out by some prominent short sellers who have been pointing out that the stock is overvalued and inflated by the sale of loans the company originates, not from selling cars. Well, it is true that those loans represent the lion's share of the $308 million profit that Carvana just posted for the second quarter. But the company's CEO, Ernest Garcia, said sales have been growing and that the company has a lot of room to run, as it only has 1.5% of the used car market share at the moment. And finally, stocks of aircraft engine makers are flying this morning. Rolls-Royce share price soared by nearly 11% in early trading this morning in London to a new record high. They're up about 10% now, as you can see there. This is all happening after Rolls-Royce reported a 50% increase in underlying operating profit in the first half. Underlying operating profit for the engine maker jumped to $1.73 billion in the first 6 months of 2025. That's roughly $2.29 billion from £1.15 billion a year earlier. The jet engine manufacturer was valued at roughly $110 billion yesterday evening. So another 10% gain puts its valuation at a new record high. And look at this chart. Its market value has almost doubled over the course of 2025, and the stock is up 400% in the last 2 years amid a push to optimize cost and sell more engines to wide-body planes like Airbus A350s. And we will talk more about the strategy with the CFO of Rolls-Royce, Helen McCabe. She'll be speaking to my colleague Julie Hyman later this morning here on Yahoo Finance. Finally, for our call of the day, today we look at what's next for the economy after the Fed's announcement that it was keeping rates steady for the fifth straight time, despite pressure from President Trump to cut. Today we have one key economic indicator coming in at 8:30 a.m. Eastern Time, and that's core PCE price index expected at 0.3%. And here's where inflation stands at the moment. While it has been trending down, the latest reading is at 2.7%. That's still well above the Fed's 2% target. Now, Trump has been insisting that lower benchmark rates wouldn't push up inflation. However, the central bank isn't so sure and remains in wait-and-see mode, with the Fed chair sticking to his guns, even if two Fed governors voted against consensus and supported a rate cut this month. So what happens next? Here's what Jay Powell had to say about how he's approaching future decisions.
The economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. This is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get.
Well, as you may remember, just a few days ago, President Trump seemed to lower pressure on Powell, saying that it didn't seem necessary to fire him before his term ends. So today, our question is, setting aside the politics of it all, did the Fed make the right call here? Well, Esther George is former president and CEO of the Federal Reserve Bank of Kansas City. She joined Market Domination with Josh Schafer to discuss the Federal Reserve's decision.
The Fed is expected, they hold rates steady. Esther, first give me your take on that. Was that the right decision, Esther?
Well, I certainly supported that decision, and I think they telegraphed that pretty well, which is they were in a mode of waiting to see how the economy unfolds. And to be honest, Josh, they are really waiting to get some conviction around inflation to ensure that that is going to be coming back toward their 2% target.
When do you think we get that conviction, Esther?
Well, I think it's a great question. You're seeing the economy slow compared to last year. We see, I think, the uncertainty that has been plaguing the economy for the past few months playing out here. And the question is, you know, the economy is still growing. People are beginning to understand to some extent how to manage their businesses in this kind of environment. So the things that are pushing, I think, as upside to that inflation story have to do with the financial conditions we've seen, which have eased since the Fed's last meeting. We continue to see a lot of deficit spending coming out of the government. We're going to have a lot more Treasury issuance coming out here. And the direction of travel is to deregulate. So there are some things here that I think the Fed has to keep their eye on when they are trying to develop that confidence and ensure their credibility around their inflation target. The Fed chair matters a lot. This is the leadership role for the committee, a very large committee, as you noted. It is one vote, but the real responsibility of this leadership position is to bring consensus, is to provide the leadership that says, how have we taken in the information, how are we reading the data, and how do we position our decision-making for the long term, and not just a meeting by meeting reaction to the data. So it is a very critical role. It's one that has to focus on the long run, and the design of this institution was intended to make sure that they were able to do that.
OK, that's all we've got time for, but let's have a quick look at the markets boards. We'll start with Asia. Some pretty bad data out of China, sending the Chinese markets lower there, as you can see. In Japan, the Bank of Japan kept rates on hold. In Europe, it's a pretty positive picture in general. That's because earnings results were, well, they've now slipped into the red, but earnings results have been on the whole pretty positive. And let's quickly have a quick look at the US markets. And it is looking like another positive start for the day. And, well, that's it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up at 9 a.m. Eastern, join Julie Hyman ahead of the market open on Morning Brief. And don't forget, we'll hear from the CFO of Rolls-Royce as well. Now, also remember, we've got that PCE data out in about an hour's time as well. That will be key as well to what the Fed does in September. I'm Ramzan Karmali. You've been watching Market Sunrise. Go own the morning.